Right now, over $13 trillion of blind money is floating in the United States stock market, operating completely on autopilot. It is sitting in the 401ks of the people you work with, the pension funds of your old school teachers, and likely right inside your own brokerage account. 20 years ago, Wall Street was dominated by humans making discretionary decisions. Portfolio managers would read through dense earnings reports, analyze cash flows, and build financial models to determine what a company was fundamentally worth. If a stock was cheap, they bought it. If it was expensive, they sold it. But human beings are emotional, and active fund managers proved shockingly bad at consistently beating the market. When studies revealed that roughly 90% this shift towards set-it-and-forget-it indexing created a massive, unthinking financial machine. Today, 63% of all United States stock funds follow the index on autopilot, ignoring earnings reports and forward guidance in favor of automated capital flows. Consider the mechanics of a modern biweekly paycheck. When that money hits a retirement account, it is automatically funneled into the index. There is no human intervention to ask if the price of the underlying assets actually reflects their value. This chart shows the current reality of the S&P 500. While the index implies broad diversification, 7 tech giants now account for over 41% of the market's total returns. Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia have expanded to make up roughly 36% of the entire index. Because of this weighting, your retirement money is forced directly into these specific stocks, regardless of their actual price. Every automatic contribution pushes more capital into a concentrated group of tech leaders, regardless of the heat in the market. The S&P 500 label currently functions as a wrapper for a highly concentrated tech fund. Investors hold a high-risk portfolio where the health of the entire index is now tethered to the performance of a handful of companies. This concentration is driven by market cap weighting. In this system, a company's influence inside the index grows directly as its total market value grows. The bigger a company gets, the more capital it automatically receives every single time a new dollar flows into the fund. This creates a blind feedback loop that rewards momentum over company fundamentals. As prices rise, the index is forced to buy more, bloating valuations further and further away from historical reality. The results are visible in the current price-to-earnings ratios. While the long-term average for the S&P 500 is around 16, it currently trades near 31. Nvidia sits at 50 times earnings, Tesla at 247, and companies like Palantir and Datadog have reached multiples exceeding 400. Investors have largely stopped pricing in future cash flows in favor of pre-ordering hope. The market has trained an entire generation to assume stocks only go up, creating a psychological bias that ignores the risks of these extreme valuations. This mirrors the Nifty 50 era of the early 1970s. Investors poured money into a group of blue-chip monopolies like Coca-Cola, McDonald's, and Polaroid. The narrative was identical to today. These companies were so dominant that you could buy them at any price and never have to sell. Then came 1973. Oil prices quadrupled, inflation surged past 11%, and the macroeconomic dominoes began to fall. The illusion of invincible one-decision stocks shattered instantly. The market plummeted 50% between 1973 and 1974. Coca-Cola collapsed by over 60%, and Polaroid lost over 90% of its value. Investors were trapped in a financial purgatory for 8 years just to break back even. History shows that passive money often becomes the ultimate bag holder when these cycles turn. The current belief in tech invincibility is a historical rhyme of a trap that has reset the market before. Today's market foundation is even more fragile due to the algorithmic machinery lurking underneath. Quantitative hedge funds and systematic traders control billions in assets, trading entirely on rules-based momentum rather than company narratives. Adding to this is the explosive growth of the options market, where same-day expiration contracts now make up roughly 63% of all S&P trading. This $2 trillion daily market forces options dealers to constantly hedge their books by buying and selling underlying stocks in real time. This creates a negative gamma regime. When the market is rising, dealers are forced to buy, pushing it higher. But when the momentum turns, that same machinery can violently drill the market into reverse, as dealers aggressively short stocks to hedge their exposure. The structure of modern finance has weaponized volatility. This automated machinery is now calibrated to transform even a minor correction into a high-speed freefall. The spark won't need to be a catastrophe. A simple reversion to the mean, a slight miss in big tech earnings, or a sudden tightening of global liquidity will be enough to turn the tickers red. Because the index is market cap weighted, a drop in a giant like Nvidia instantly bleeds into the S&P 500. The concentration that smoothed the way up now creates immediate broad market pressure. As the downward trend is detected, systematic trading algorithms flip from long to short in milliseconds, dumping tens of billions of dollars in equities. The mechanical feedback loop that pumped the market up instantly turns into an inescapable downward spiral. Options dealers begin aggressively shorting to stay delta neutral, while massive hedge funds hit strict drawdown limits. In this environment, they don't sit in a conference room to debate the fundamentals. They simply sell. The crash becomes a purely mechanical chain reaction. Fundamentals and company value are rendered irrelevant by the requirements of the financial plumbing. This is where the trap snaps shut on the $13 trillion of passive retail money. When everyday investors see their retirement vanishing and hit the sell button, they trigger the final phase of the crunch. Passive funds facing mass redemptions are mathematically forced to liquidate their holdings. Because the indices are so concentrated, they aggressively dump the exact same tech stocks everyone else is selling. The exit door is too small for the capital trying to escape. By the time a retail investor reacts, the systematic algorithms and institutional whales have already exited. They utilize high-frequency advantages to move first, leaving the blind money to absorb the full impact of the unwinding. The math reveals a heavily concentrated momentum trade disguised as a diversified plan. When the systematic unwinding begins, the blind money is positioned to absorb the impact.